Welcome to the deep dive. Today we're doing something pretty special. We're taking an immersive journey through the 2004 annual report from Giverny Capital Inc.
Right.
Our mission here isn't just to, read out the numbers. We want to really unpack their distinctive investment philosophy. Learn from their successes, sure, but also from the mistakes they were actually quite open about.
Yeah, that's the interesting part.
And really get a feel for what being a true long-term investor means in practice. Think of it like a shortcut, a way to get deep insights into how their focused, patient approach actually works day to day.
Sounds good.
So let's kick things off with 2004. What were their reported returns that year? I see global Giverny portfolio, 1.6% in Canadian dollars.
Yeah, pretty modest.
And the international portfolio, 9.3% in U.S. dollars.
Yep.
But the S&P 500 did 10.7% in U.S. dollars.
Yeah.
So they said themselves they were hard to be happy about this.
Yeah.
Why was that? What was really going on?
Well, a big factor was currency. The U.S. dollar actually dropped about 7% against the Canadian dollar that year. And since something like 80% of that global portfolio was in U.S. stocks, that drop really hit the Canadian dollar return.
Right, that makes sense.
But, from their perspective, over the long haul, these currency swings tend to even out. They mentioned that since '93, the U.S. dollar had only lost about 0.6% a year against the Canadian dollar. So, yeah, a headwind in 2004, but not something they obsess over.
So not the currency then. What did make them happy, despite those headline numbers?
What made them happy was the performance of the businesses they owned. Their underlying companies actually had a great year.
Okay.
Across the board, the combined earnings of the companies in their portfolio were up 20%. That's pretty strong.
20%, wow. So what the gap with the index?
The real reason they underperformed the index in '04 was simple. They didn't own resource stocks, basic materials, energy. That sector was hot then. And it's a sector Giverny just consistently avoids. They don't feel those businesses have the kind of lasting competitive advantages they look for.
Okay, that really sets up the next point, doesn't it? Their core approach. They make it clear that returns are just a result, the outcome of this investment philosophy that all their partners have to fully adhere to.
Exactly. It's non-negotiable.
So what are the key parts of this philosophy? What makes it tick?
Well, there are a few foundational beliefs. First off, they think trying to time the market, predict the best time to buy or sell is just, pointless, futile.
Right. Forget market timing?
Yep. Second, they firmly believe a stock's return over time will basically mirror how much the company's intrinsic value per share grows, and that's often tied to its return on equity.
Intrinsic value growth is key.
Absolutely. Third, they're incredibly selective about which companies they buy. They want businesses with sustainably high margins, high returns on equity, really good long-term prospects.
Good management.
And managed by, as they put it, brilliant and devoted people. Fourth, you need a realistic sort of ballpark assessment of what that intrinsic value actually is. Fifth, and this is a big one, they see the market's irrationality as their friend, an ally. Lots of people treat the market like a casino.
Yeah, definitely feels that way sometimes.
Right. But Giverny sees that chaos as creating opportunities to buy these fantastic businesses for way less than they're actually worth.
Turning volatility into an advantage.
Precisely. And the final crucial ingredient is patience. Both their own patience and their partners. They really hammer this home.
How so?
They say, if we're right on the business, we will eventually be right on the stock. And you can't judge an investment properly over less than, say, 5 years. They use that great analogy. To stare at a freshly planted tree does not make it grow faster. You just have to let it grow.
Love that analogy.
Yeah.
And you mentioned they deliberately avoid certain types, specifically commodity-like businesses. Why is that?
Yeah, they really prefer companies where the most important assets are intangible things like knowledge and brand.
Like tech or consumer brands?
Yeah, exactly. Think Astral Media, Johnson & Johnson, Cognex, ResMed, companies like that. Their costs aren't massively impacted if oil or steel prices suddenly jump. It leads to more predictable earnings.
Makes sense.
They even quote Buffett, no one ever asks, I want a Coke only if it comes in an Alcoa aluminum can. The brand, the formula, that's the value, not the commodity input.
Right.
And interestingly, they point out the U.S. economy was actually becoming less dependent on basic materials over time. Back in 1970, you needed about 1.3 barrels of oil for every $1,000 of GDP.
Okay.
By 2004, that was down to just 0.64 barrels. So the economy itself was shifting away from those basic inputs.
So it sounds like this philosophy gives them a kind of luxury in how they invest. What does that look like in
That
practice?
really does. It's a huge advantage. They basically avoid any sector or business that's outside their circle of understanding.
Yeah.
They don't feel pressured to play in every sandbox. Their
Mm.
focus is just on finding strong companies they understand and holding them for the long term, knowing they can likely weather economic storms.
Which is pretty different from most managers.
Totally different. Most managers feel immense pressure to beat quarterly benchmarks or to be invested in whatever sector is hot right now, even if they don't fully get it.
Right.
Giverny uses this great baseball analogy. It's like they're at bat, facing the stock market pitcher, but no strikes are ever called.
Ah,
So they can just stand there and wait, choosing only the absolute best pitches, the opportunities they really like and understand to swing at.
that's a fantastic way to put it. Now, staying with 2004, they talked about the flavor of the day and were skeptical of trends, particularly that basic materials boom we mentioned.
Yeah, they weren't buying into the hype. And they shared this really telling anecdote from Business Week around January 2005.
What was that?
For the first time in about 20 years, a seat on the Chicago Board of Trade, which is heavily linked to commodities futures, right,
Hmm.
sold for $1.25 million.
Wow.
And that actually surpassed the price of a New York Stock Exchange seat, which had fallen to around $975,000. It just perfectly captured how popular, how much perceived value there was in basic materials and commodities trading at that exact moment. Giverny saw that and, well, they remained cautious.
So they have their core beliefs, their specific avoidances, and this patience. They also have this practical framework, the rule of three. Can you break that down?
Yeah, the rule of three, it's based on their observations of history, and it's very pragmatic, keeps them grounded.
Okay, what are the three parts?
First, 1 year out of every 3, expect the stock market to drop at least 10%. It just happens.
Right, market corrections are normal.
Second, 1 stock out of every 3 they buy will likely turn out to be a disappointment. Not every pick will be a winner.
Okay, acknowledging fallibility.
And third, at least 1 year out of every 3, they expect to underperform the index. They won't beat it every single year.
So what's the takeaway from those rules? How does it affect how they operate?
The consequences are really psychological, mostly. It means they are mentally ready for market downturns. They expect them.
Not caught by surprise.
Exactly. It also means they judge the portfolio as a whole, not obsessing over whether every single stock is up. Some will disappoint, and that's okay.
Diversification helps there, I guess.
And it means accepting that underperforming the index sometimes is just normal. It's part of the process. If you have a distinct strategy, it prevents them from panicking or chasing trends just because they lagged for a year.
That's a really disciplined mindset, building expected failure into the model. How do you think most investors would react to that? It seems counterintuitive.
Oh, absolutely. Most investors, even many professionals, really struggle with that. The pressure to always be right, always outperform now is huge.
Yeah.
It leads to short-term thinking, chasing performance, making reactive trades. Giverny's rule of 3 kind of liberates them from that pressure.
So they can stick to their knitting, basically.
Exactly. Stick to the long-term plan, focus on intrinsic value, and ride out the inevitable bumps without freaking out. It's a huge part of their long-term success.
Which brings us to that long-term success. This philosophy, this patience, it clearly works over time. What does the track record actually look like?
It's pretty remarkable, honestly. It really shows the power of their conviction. So from when they started the fund, July 1st, 1993, up to the end of 2004.
Okay, about 11 and a half years.
Right. Their main global Giverny portfolio delivered an annualized return of 19.9%. That's in Canadian currency.
19.9% compounded. That's huge. How did that compare?
It significantly beat their own benchmark and also the S&P 500. Both of those came in around 10.4% annualized over the same period.
So almost double the market return.
Pretty much. And just to put a dollar figure on it, if you'd invested $100,000 with them back in July 93, by the end of 2004, it would have grown to $807,700.
Wow, that's the power of compounding with high returns.
Definitely. Their international portfolio also did very well, and they mentioned their RRSP portfolio, that's like a Canadian retirement account, had this unique record. Over its first 10 years, it never had a single negative year.
No down years in 10 years. That's impressive consistency.
Very impressive.
Okay, so they talk about acting like museum directors, only seeking masterpieces for their portfolio. Let's look inside the gallery. What were some of these long-term holdings they highlighted?
Sure. One they talked about was M&T Bank. They'd owned it since 1998.
Right.
By 2004, its earnings per share had basically doubled from around $3 to over $6. That's like 13% annual growth.
Solid. And the stock?
The stock followed, going from about $45 to $107. But what's interesting is it wasn't a smooth ride.
Oh.
During the tech bubble bursting around March 2000, M&T stock actually dropped 20%. But Giverny didn't panic. They saw it as an opportunity to buy more.
Buying a good business on sale.
Yeah.
Classic value thinking.
Exactly. Another one was Groupe BMTC, a Quebec furniture retailer. They'd held it for 10 years already by 2004.
Furniture, okay.
Yeah, and despite facing a strike and a new competitor that year, the business held up really well. EPS was still up 30%.
Wow, why so resilient?
They pointed to superior operating metrics compared to a competitor, the Brick. BMTC had like 3 times the revenue per store, much faster inventory turnover, 12 times versus 7.
Meaning they sold stuff quicker.
Right. And a return on equity over 20%, while the competitor was under 10%. Just fundamentally stronger operations.
Okay, who else?
Then there's Cognex, machine vision company, owned since '96. They actually called this one a so-so investment initially, stock-wise.
Oh, admitting it wasn't perfect.
Yeah, but they held on because they loved the business itself. It had a near monopoly in its niche, could earn like 30% on sales in good years, and had a fantastic balance sheet, tons of cash.
So faith in the underlying business.
Faith and patience. They believed it would eventually pay off. Then there was Walgreens, the pharmacy chain, called it a favorite.
Walgreens, yeah, big name.
EPS up 19% in 2004, and that was its 17th year in a row of 10% or more EPS growth.
17 years. Incredible consistency.
Just a compounding machine. Biggest player, best balance sheet, and still room to grow, only having about 12% of the prescription market then.
Okay, any others jump out?
Expeditors International, the logistics company, strong 2004, EPS up 26%, stock had doubled in under 3 years. They really valued the CEO, Peter Rose, saw him as a key asset.
Management again.
Always. They also bought into W.P. Stewart & Co., another money manager, starting in 2002. Why? Because its investment philosophy was so similar to their own.
Interesting. Investing in a kindred spirit.
Kind of. Plus, it had a nice 6% dividend yield when they bought it and had outperformed the S&P 500 despite managing a hefty $9 billion.
And they mentioned a new purchase.
Yes. Knight Transportation, a trucking company. They'd followed the industry for a while and liked Knight better than a competitor, Heartland Express.
Why Knight?
Knight focused on organic growth, opening new centers, rather than just buying other companies like Heartland did.
Okay.
And critically, the management structure. 4 family members owned 9% of the stock and all took the same reasonable salary. Their interests were aligned with shareholders.
Skin in the game.
Exactly. Plus, a great track record, 10-year EPS growth of 26%, compounded, solid balance sheet. Even though the PE was around 20 when they bought, they saw the quality.
That really shows the depth of their analysis, business model, management alignment. It feeds into that idea you mentioned, that they see themselves as owners.
Precisely.
And that brings us to this metric they track. Owners' earnings. They say it's almost as important as yearly returns. Why is that so central for them?
Because, as you said, they think like owners. So their main focus isn't the stock price day to day. It's the growth in the underlying intrinsic value of the companies they own. Primarily, that means earnings per share growth.
Right. The business's performance, not the market's mood.
Exactly. And they used 2004 as a perfect example. Their stocks in constant currency were up maybe 8%. Okay, not bad. But the underlying intrinsic earnings of those businesses, up 20%.
Big difference.
Huge difference. It shows that short-term disconnect they're willing to live with. Their goal isn't just market-beating returns. It's finding companies that can grow their value at a 12-14% a year consistently. That's about double the market average growth.
And they acknowledge that market performance and business performance don't always line up in the short term.
Oh, absolutely. They explicitly state that while things align over many years, there can be wide gaps in the short run. They even pointed out that between 96 and 04, their portfolio's market return underperformed its underlying business earnings growth in 4 of those 9 years.
0 to 9. Wow.
Yeah, 1999, 2000, 2002, and 2004 again. It just drives home why that patience is so critical. You have to believe in the business growth even when the stock price isn't reflecting it yet.
Okay, but even with all that discipline, nobody's perfect.
Yeah.
And Giverny seems unusually willing to talk about their mistakes. They call it mistakes du jour.
Yeah, it's incredibly refreshing, very candid. They quote Oscar Wilde, "Experience is simply the name we give our mistakes."
Love it. So what can we learn from where they admit they stumbled?
Well, they start with an honorable mention, kind of a smaller mistake. Krispy Kreme.
Oh boy, I remember that one.
Right. They bought a small position, maybe 1%, and ended up selling it for a 70% loss.
Ouch. What was the lesson?
They realized too late how much the business model depended purely on rapid new store openings for growth. It wasn't sustainable. They even quoted Peter Lynch.
The Fidelity guy.
Yeah. Lynch said, more companies die of indigestion than starvation. Basically, growing too fast can kill you.
Good point.
But the key lesson there was position sizing. Because it was only 1% of the portfolio, that 70% stock loss only cost them 1% of their total capital. Risk management worked.
Okay, so manage the size of your bets.
Crucial. But then they get into what they see as potentially bigger mistakes. Omission mistakes. Opportunity costs.
The ones that don't show up on the statement.
Exactly, the mistakes you don't see in our reports. They give an example. If you don't invest a typical 4% position in a stock that then goes up 200%.
You missed out on an 8% gain for the whole portfolio.
Right. That's a real, albeit invisible, loss. Those can be more damaging than small losing positions.
That's a powerful way to think about
Yeah.
it. So what were the actual medal winners for mistakes?
Okay, the bronze medal went to NVR Inc., a home builder.
A home builder.
Yeah.
Seems cyclical for them.
It is, but this company had incredible returns on capital, like 80%, and staggering EPS growth from $1 in 1995 to $63 in 2004.
Wow.
They looked at buying it around $150 a share, which was only 7 times earnings. Super cheap.
So why didn't they?
They got nervous, worried about stock options diluting shareholders, worried about the housing cycle turning.
Understandable worries, maybe?
Maybe, but they concluded they made a mistake. They didn't use enough judgment, let short-term fears stop them from buying what they admitted was an outstanding business, well-managed, and with good long-term prospects.
And the stock.
It went to $770.
Yeah, big miss. Okay, silver medal.
Silver goes to Pixar.
Pixar, the animation studio.
Yep.
They followed it from its IPO in '95. After seeing Monsters, Inc. in 2001, they knew Pixar was the real deal, not just a fad.
Right.
The stock was trading around $30 then, way off its highs, and had $5 a share in cash. Looked interesting.
But they didn't buy. Why not?
They decided against it. They were worried about profits being unstable, maybe too dependent on Disney for distribution.
Okay.
The mistake, they said, was a lack of perspicacity, a failure of long-term thinking. They later realized Disney actually needed Pixar more than the other way around.
The power dynamics shifted.
Right. Pixar could negotiate better deals. And with more movies coming out Finding Nemo, The Incredibles' profits stabilized. The stock soared 200% in 3 years to $85. They just didn't see the long-term picture clearly enough.
Another painful miss. Okay, what earned the gold medal of mistakes?
The gold medal.
Yeah.
This was actually the second time this company won their Mistake du Jour award. It was Yahoo.
Yahoo. Again, what happened this time?
Okay, so they had bought Yahoo back in 2000 at around $12.
Mm-hmm.
Then the dot-com bust happened.
Mm-hmm. The stock crashed, hitting a low of $4 in 2002. And at that price, $4 a share, the value is basically covered just by Yahoo's stake in Yahoo, Japan, plus its cash on hand.
So the core Yahoo business was essentially free.
Pretty much free. Crazy cheap. So what should they have done?
Backed up the truck and bought more, presumably.
Exactly. They said they should have been aggressively buying, but instead, they stayed still.
Why?
They were disappointed. The CEO had left. Revenue had dropped. They lost conviction at the bottom.
Understandable but costly.
Very. They ended up selling their shares at $8 in late 2002, using the money to buy Cognex instead. Now, Cognex did well. It doubled.
Okay, not a disaster then.
Not a disaster, but Yahoo did way better. New management came in, tripled revenues, quadrupled earnings per share in just 2 years. The stock hit $38.
Wow. From the $4 low or the $8 they sold at, huge gain missed.
Huge. And their conclusion on this golden caliber mistake? Simple. They were not patient enough. It perfectly highlights why they keep stressing long-term, long-term, long-term.
Incredible lessons in humility there. So, pulling it all together, what's the big takeaway? It seems like investing at this level is about more than just spreadsheets.
Oh, absolutely. It really transcends numbers. There's a deep human element. They actually reference the philosopher Erich Fromm.
Fromm? Okay.
Yeah, Fromm talked about creativity. He said, genuine creativity needs the courage to let go of certainties, to embrace a state of constant mind-opening.
Okay. How does that relate to investing?
Giverny argues that real investment success comes from combining rationality and judgment with that kind of independent thinking, that creativity, being willing to think differently.
Which isn't always easy, especially with money.
Exactly. It's hard, especially for people who've already accumulated capital and naturally seek security. Letting go of certainty feels risky.
True.
They also bring in wisdom from another legend, Philip Fisher.
Fisher, right. Common stocks and uncommon profits.
That's the one. They recount Fisher's advice that the quality of the management makes up 90 to 120% of the success of a business.
90 to 120%. How does that work?
Yeah, it means great management is not just essential. It can actually overcome other weaknesses or unlock potential beyond what seems possible. It's that important.
Underscores their focus on people.
Totally. And they tell this little story about the firm's CEO hunting down a super rare 1960 book by Fisher, Path to Wealth Through Common Stocks. Couldn't find it anywhere to buy.
So what did he do?
He eventually found a copy at the New York City Central Library and literally photocopied the entire thing.
Dedication.
It just shows the lengths they go to absorb these deep foundational ideas about what really drives long-term business and investment success. It's not just a job for them.
What an incredible deep dive. We've
Yeah.
really seen the power of sticking to a philosophy, the amazing results patience can bring, but also the crucial lessons learned from mistakes.
Yeah.
And that underlying human element, the independent thought, the creativity.
Absolutely. Maybe a final thought to leave you with. Consider how often in your own life, maybe in finance, maybe elsewhere, real success comes not from dodging every single challenge, but from keeping that patience and conviction through the tough times, especially when your gut instinct might be screaming to run the other way. What certainties, maybe outdated beliefs or assumptions might you need to have the courage to let go of to make space for your own kind of independent thinking and that mind opening?